Two things happened in China's property market in the last few days that do not sound dramatic, but they changed the plumbing. First, reporting out of Beijing says China has ended the 3 red lines debt limits for developers. Second, banks were told they can extend loans on priority property projects by as much as 5 years. That is not a bailout headline. It is a rule change about time and credit. By the end of this video, you will know what this policy unwind actually loosens, what it does not fix, and 3 signals you can track to tell whether this turns into stabilization or just another short rally. Here is the verified setup. The 3 red lines framework, introduced in 2020, tied a developer's ability to borrow to balance sheet tests. Think leverage, liquidity, and how much short-term debt was covered by cash. When financing got constrained, cash flow stress turned into defaults, stalled construction, and a confidence shock. The new reporting says that in January 2026, authorities ended that framework. At the same time, banks were allowed to extend loans for whitelist or priority projects by up to 5 years. The whitelist part matters because it is not theoretical. China's regulators set up a coordination mechanism for urban real estate financing in early 2024, together with housing authorities, to push funding toward specific projects. And Chinese media has cited housing ministry data, showing approved loans for whitelist projects running into the trillions of yuan. Markets reacted the way you would expect to a loosening headline. China property shares jumped, including indexes tracking mainland and Hong Kong listed developers. But the more important question is not the stock pop. It is whether cash can get from a bank balance sheet into a half-built apartment tower without reigniting the old leverage loop. Keep one picture in your head. A mid-sized developer has an apartment project that is 70% built. Buyers already put down deposits. Contractors want to be paid. The bank has a construction loan that is coming due. Under stress, the bank wants out, and the developer has no refinancer. The project stalls, and buyers stop trusting pre-sales. Call this the unfinished tower problem. If you can solve this, you can stabilize confidence without giving developers a blank check. Now, what does ending the 3 red lines actually do? In plain English, it removes a hard gate. Those debt ratio thresholds were a visible rule that told banks and markets who was allowed to borrow. Even when a developer had assets, the rule could force deleveraging at the worst moment. Removing it gives regulators more discretion. It also gives banks more room to roll loans instead of demanding repayment in a down market. The loan extension piece matters because of maturity walls. If a construction loan matures this year, a bank normally has to either renew it under current credit standards or push for repayment. Extending by up to 5 years is basically saying, do not force liquidation just because the calendar hit. That buys time for a project to finish, units to be delivered, and cash to come back in. Here is the first receipt moment. On screen, you would put the Reuters line that says the 3 red lines policy was ended, and right next to it, the line about banks being able to extend loans for priority projects by up to 5 years. That combination is the story. It is not about one developer. It is about system-wide refinancing pressure. But there is a catch. Removing a constraint does not create demand. China's property problem is now as much about households as it is about balance sheets. Developers and analysts have been blunt that sales and prices are still weak, and banks are still cautious about new lending. So, you get 2 layers of reality at the same time. Policy is loosening on the supply side. Confidence is still tight on the demand side. Here is the mechanism chain you need to hold on to. Step 1. A rule change reduces forced deleveraging. That can slow the pace of defaults. It can also reduce fire sale pressure on land and projects. Step 2. Loan extensions reduce near-term cash squeezes. That can keep projects moving. Finished projects are the fastest way to rebuild trust in pre-sales. Step 3. If projects deliver, households may stop treating pre-sales like a credit risk. That is when sales stabilize. That is when local governments stop bleeding land sale revenue. Now, connect this to markets. Start with rates. A stabilization story can reduce deflation risk and improve growth expectations. That can push Chinese government bond yields higher at the margin because the market prices less emergency easing. If the story fails, yields can fall again on weak growth. Then, FX. If growth fears ease, the yuan tends to be less under pressure But if the rule change reignites credit growth without real demand, it can worsen capital outflow worries. So, the yuan reaction is conditional, then credit. Chinese developer dollar bonds have traded like distressed credit for years. If investors believe unfinished towers will be finished, spreads can tighten quickly. If this is only optics, spreads will widen again, even if equities keep bouncing, and commodities. Property is a big marginal driver of steel demand. A real construction restart shows up in rebar margins, iron ore prices, and shipping volumes. A paper policy move does not. Back to our unfinished tower. If the bank can extend the loan, contractors keep working. That is the first new consequence. It is not a profit story. It is a cash flow timing story. Now, lock in the three signals that decide whether this is real. First, China's official 70-city new home price data and property sales releases. You are looking for the rate of decline to slow, not a sudden boom. These prints are monthly, so the lag is weeks. Second, the People's Bank of China credit data, especially new medium and long-term household loans, and total social financing. If credit keeps shrinking, demand is not healing. These are usually monthly too, with a short reporting lag. Third, the offshore market stress meter, the spread and price action in Chinese developer dollar bonds and Asia high-yield credit. If policy is working, credit should stabilize before equities do. This can move daily. If those three do not improve together, the rally is fragile. And one more detail matters for the plumbing. Beijing has also tried to deal with excess inventory, not just unfinished projects. In May 2024, the central bank announced a 300 billion yuan relending facility to support state firms buying completed unsold homes for affordable housing. That is a different channel. It is about clearing finished stock. The whitelist is about finishing what is not done. Next, the question is where the stress reappears first, even if headlines stay calm. The next question is simple. Where does this show up first if it fails? It shows up in delivery, not in a press release, not in a share price. If the unfinished tower still sits quiet, buyers notice. If deliveries rise, confidence has a reason to return. This is why the whitelist matters. It is not broad stimulus. It is targeted to specific projects. Here is the second receipt moment. China's housing ministry data showed approved loans for whitelist projects surpassing 7 trillion yuan. That is about $1 trillion at current rates. Put that number on screen with the source line. It tells you scale and intent. Now add the bank side. The National Financial Regulatory Administration described the financing coordination mechanism in early 2024. In one update, it said approved loans for whitelist projects reached 935 billion yuan by mid-May 2024. That is your primary source receipt for the pipeline, so the system can move money. Then why do developers still sound doubtful? Because money that is approved is not always money that is used, and used money still has to turn into deliveries. Look at the inventory clearing tool. In May 2024, the People's Bank of China announced a 300 billion yuan relending facility. It was meant to fund state firms buying completed unsold homes for affordable housing. That sounds powerful, but Reuters later reported that only 16 billion yuan had been used by September 2024. That is a gap between headline size and real uptake. This gap is the whole risk. Policy can build channels, but incentives decide if anyone walks through them. Back to our unfinished tower. Loan extensions can keep the project alive. That is consequence 2. Contractors can keep crews on site. Suppliers can ship materials, but only if the bank actually renews. Banks still have a reason to hesitate. Property loans tie up capital. They also tie reputations to a sector under scrutiny. Even with official encouragement, risk officers stay conservative. This is why the rule change is not a magic switch. Ending the 3 red lines removes a bright red stop sign. It does not remove fear. Here is why officials chose this approach. They have been easing around the edges for 2 years. Reuters lists mortgage and down payment loosening, including cuts as low as 15% in 2024. It also notes some purchase restrictions lifted in parts of Shanghai and Beijing in 2025 and early 2026. There were also swap old for new apartment programs in major cities. Those are demand nudges. This new move is a credit timing fix, and the legacy damage is still visible. China Evergrande is in liquidation proceedings. Country Garden has restructured offshore debt. China Vanke has sought repayment deferrals to avoid a near-term default. Those names matter because they shape bank behavior and buyer psychology. So what breaks first if the story worsens? First pressure point is the local government. Local governments depend on land sales and fees. If property demand stays weak, that revenue stays weak. Then local financing vehicles feel strain. That shows up as wider spreads and more roll risk. Second pressure point is the bank funding channel. If property exposures keep rising without better sales, banks get cautious elsewhere. That can tighten credit for small firms. Then growth slows again. Then the property hold deepens. Third pressure point is the household. If buyers still fear non-delivery, pre-sales stay frozen. Then developers lose their main cash engine. That is when more projects stall. Now, watch how this crosses into global markets, not in one burst, in a slow bleed. If China growth expectations improve, commodity demand firms. Iron ore and industrial metals can catch a bid. If growth expectations fall, those markets soften. Then Asia FX reacts. A steadier China can calm regional currencies. A weak China can pull them lower through trade links. Global rates then take cues. When China deflation risk rises, it exports disinflation. That can anchor long-end yields elsewhere. When China demand firms, it can lift global inflation tails. Now, the timeline you should use. In the next 24 to 72 hours, you are watching for follow-through, not in speeches, in financing data and bond pricing. Do we see more reports of extensions being granted? Do we see a calmer tone in Asia high-yield credit? Do we see property equities holding gains without fresh headlines? Over the next 2 to 6 weeks, you are watching delivery and sales proxies. You want signs that projects are finishing. You want signs that prices are stabilizing, even slowly. If this persists into spring, the stakes shift. Then it becomes a macro drag story again. It pulls on consumption, local budgets, and bank risk appetite. It starts shaping Beijing's growth choices for 2026. Now, lock the 3 signals again, with the exact places to look. Signal 1 is official home price and sales data. Watch the 70-city new home price index and nationwide sales. Direction that matters is a slower decline or flat prints. The lag is a few weeks because it is monthly. Signal 2 is credit demand from households. Watch PBOC data on new medium and long-term household loans. Rising numbers suggest buyers are borrowing again. The lag is also monthly, with early month releases. Signal 3 is offshore credit stress. Watch Chinese developer dollar bonds and Asia high-yield spreads. Tightening spreads tell you funding fear is easing. This can move daily, before the data. Now, the risk framing. It is possible these steps reduce near-term stress. It is also possible they only stretch the timeline. If sales stay weak, time alone does not heal balance sheets. One more nuance. Abolishing 3 red lines can change behavior at the margin. Developers can try to refinance. Banks can choose to roll instead of demand cash. But authorities still want support, not stimulus, in the narrative. That means targeted help, not a broad credit boom. So, your base case should stay conditional. This is a policy unwind meant to prevent new accidents. It is not proof of a full rebound. Next, we put numbers on the scoreboard. We map what this means for China risk assets, and we tie it to the dollar and rates. Now, put this story on a scoreboard. Start with the simplest question. Did Beijing remove a constraint, or did it change incentives? Removing 3 red lines is constraint removal. It tells banks and developers that the old hard ratios are no longer the gatekeeper. Extending priority project loans is incentive shaping. It tells banks, your safest choice is to finish, not to foreclose. For our unfinished tower, that is consequence 3. The bank can say yes without pretending the sector is healthy. It can frame it as loss prevention. Finish the building, deliver the keys, stop the confidence bleed. Now, watch how you would prove that this is working. First proof channel is delivery and completion. If completions accelerate, this policy is doing the one thing it is designed to do. Second proof channel is the cash engine. Pre-sales and mortgage lending have to stop deteriorating, not because prices surge, because buyers stop acting like delivery is uncertain. Third proof channel is pricing of risk. If China developer dollar bond prices stop gapping and spreads tighten, investors believe that cash flow timing is improving. That is the inner story. Now the cross-asset story. Commodities. Property is a steel, cement, copper, and freight story. So, if you want a fast market read, you watch iron ore and rebar margins. If iron ore firms while property sales stabilize, that is a classic confirmation loop. If iron ore stays heavy while property equities rally, that is a mismatch. FX. If China stabilization is real, the yuan does not need aggressive defense. That reduces the China exports deflation fear. But there is a flip side. If policy loosening leads to faster credit growth without better sales, capital outflow pressure can return. So the yuan signal is not up is good, it is stable is good. Rates. If the property drag eases, China's bond rally can stall, and yields can drift up from very low levels. If the drag worsens, you can get the opposite, more demand for safety and more easing bets. Now, tie it to the dollar. A weak China tends to increase global demand for dollars. It pulls risk capital toward the US and away from EM. A stronger China can do the reverse, but only if the rest of the world is not in a separate shock. So this topic matters outside China. It is a global risk appetite lever. Now, we revisit the anomaly scanner. The mismatch we are watching is this. Policy channels can look big on paper. The PBOC relending facility was 300 billion yuan, but Reuters reported only 16 billion yuan was used by September 2024. That is not a small gap. That is a signal about friction. Now, the whitelist loan approvals. NFRA described hundreds of billions of yuan approved early. Chinese media later cited approvals passing 7 trillion yuan. The only question is conversion, approved versus drawn, promised versus delivered. That is why I keep the unfinished tower in the frame. If the tower gets finished, conversion is happening. If the tower stays frozen, this is paperwork. Now the exact 3 signals again, but with the timing you should expect. Signal 1, monthly housing data. The direction that matters is the decline slowing, not one print, 2 consecutive prints. Typical lag is the month after the activity. Signal 2, monthly PBOC credit data. You want to see household medium and long-term loans stop shrinking. That means mortgages are flowing again. The lag is 1 month. Signal 3, daily offshore credit stress. You want developer dollar bonds to trade less like distressed assets and more like credit. Tightening spreads and fewer gap down days are the tell. The lag is immediate. Now the stakes ladder in plain English. In the next 24 to 72 hours, the market will trade the headline. You will see bounces. You might see quick fades. The only thing that matters is whether credit and FX stay calm. Over the next 2 to 6 weeks, the story either gains traction or it does not. If completions and sales do not show improvement, confidence fades again. If there is improvement, it can become a durable stabilization trade. If this persists beyond that, the global implications deepen. A stabilized China lifts global cyclical demand. It can change inflation tails. It can change EM flows. And it can change how the Fed and the ECB interpret global disinflation. Now, the final recap. What happened is a rulebook change. China ended the 3 red lines constraints and told banks they can extend loans on priority projects by up to 5 years. Why it happened is simple. Officials are trying to finish projects and stop the confidence bleed without restarting a leverage boom. Why it matters is spillover. It hits commodities, Asia FX, and global risk appetite through demand and credit sentiment. What to watch next is exactly 3 signals. 1, housing prices and sales. 2, household mortgage lending and PBOC data. 3, offshore developer bond spreads. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.